So we finish cash discount. So when we have a cash discount, you could use gross method or net method. Either way, we accept gross method because of the time's too short, so it won't affect our financial statements too much. So that's why we accept you use gross method. Why we talk about that? Because right now we talk about the second variable consideration. 第二个变动对价. When we talk about that, sorry, you could just use second method, net methods, because net method is what we want. Okay, so we talk about the second case, second variable consideration. But right now, you should understand we could only use net methods. So what's the second one we want to talk about on your slide 45? Where we have sales returns and allowances. Okay, customer decide to return inventory back to you. For this part, also we cannot get the money from customers, right? So that's why it's our variable consideration. After that, the money we cannot receive from customers. So for second case, sales returns and allowances. No matter you got the inventory back from customers, or no matter you offer them sales allowances. Sales allowances means what? They don't return inventory back to you, but you give them cheaper price, right? So no matter which one, right now, sorry, you can just use net methods. You cannot use gross methods, okay? Because net methods is what we want. So based on net methods, how we report the situations, how much money we expect to receive from customers, okay? So this is the case we have. So what's the case? Blah blah blah. Because of that, customer don't like the products. So you are the max. You decide to grant an allowance on the sales price or agree to take the product back. So usually we will do that. The customer don't like it. You accept the returned products, right? Or you give them a cheaper price allowance. So what happened on January 4th, 2022? Your company sell the product $5,000 to customers on the account. So they didn't pay the money, right? But at that moment, remember, when you do the business, sell the products to customers, at that moment, we have to consider what? Not only fixed amount, right? We still have to consider what? Variable considerations. So since we have to consider variable considerations, then that's right. On the same day, you had to expect what's going to happen in the future, okay? So when you sell products to customers at that moment, because we use which method? Remember, you can use only net methods, okay? So what does it mean, net methods? You have to consider the variable considerations. You have to consider the net amount, what's going to happen in the future, right? So that's why we have to consider what's going to happen in the future. So you have to consider how many products maybe customer will return back to you in the future. So you expect 400 of the inventories will be returned back to you in the future, okay? You expect that because we use net methods. So based on this, how many numbers we are going to have? Net methods. I expect sales return allowances $400, right? Because I expect in the future they will return $400 products back to you. Then what's your true sales? What is the amount you expect to receive from customers? Net amount, right? So net amount, how much? $5,000. After $400, maybe they'll return the products. So the amount you expect to receive from customer only how much? $4,600. Okay. So also this is the amount we expect we will earn the revenues from customers. So $4,600 is the amount you expect to receive from customer. Okay. So at the beginning, you had to report the net amount. So $4,600 is what? Is our net amount. After you consider the consideration, the variable consideration. Okay. Any questions? But you should understand, 400, we expect that. So the amount is estimate, is not true, right? Because we expect what will happen in the future. So 400, 4,600, these two numbers are estimate, not true, because we don't know what will happen in the future, okay? Any questions? Also, did you find out our expectation will not be the actual situation? So it means what? In the future, maybe you have to do some adjustment. So did you find out? That's why net method is more complicated, because you have to do extra work to do some adjustment. Okay? So remember, in the future still, you have to do some adjustment in order to meet actual number. So this is your extra work. That's why we don't like it, because you have to do more extra work. Okay, so if you understand the numbers, how we record it? Any questions? No problem. If you remember the concept we mentioned in chapter 8. Chapter 8, we talk about what? True sale, right? I sell the product. Is true transaction or not? We mentioned that. So in chapter 8, when we talk about sales with right of returns, at that moment, we want to know is true sale or not, right? So what does it mean, true sales? For the products returned back to you is not true sale, right? So at the beginning, you have to consider what's the true sale. So in this case, we assume the true sale is what? 75%. So what does it mean? We estimate 25% of product will be returned back to you. So if we could estimate the level of return, so in this case, we estimate maybe 25%. So that 25% of inventory will return to you, right? If we still remember. So that's why we will record our true sales. The true revenue we expect is only 75. and for that 25% will return back to you. Okay. So why we use the journal entry? First is perpetual, right? So first journal entry for revenue, second journal entry for cost of goods sold. So look at our revenues. Since we knew 75 is our true sales, so I know 75 is the true sales. So I know this the revenues I'm going to earn from customers, right? So my true sales, I believe, is 75. So true sales, the product, I will have the related expenses only 75 for my true sales. Okay, so that's why my true sales only 75. 25 will return back to you. So accounting, we just recall the true situation, right? So I will recall I earn the revenue only 75. So the related expenses 75. Any questions for this part? No problem? Okay. For 75 revenue, we are going to earn from customers. So how about your accounts receivable? The question is right here. If you sold the product 100 units, so if you sold inventory 100 units, for example, okay, so for this you sold inventory 100 units, even though in the future you will get 25% back, could you tell me at this moment how many units you get to customers? 100, right? I sold 100 units to customers, even though I expect 25 units will return back to me in the future. But right now, at this moment, how many units you give it to customers? 100, right? So the inventory I gave to customers, 100. Since you gave to customer 100, at this moment, how much money you will ask customer pay you? 100. Why is that? Because I gave it 100 units. So of course, at this moment, I will ask them to pay me money 100. Okay? Any questions? So that's why our inventory decreased 100. Why? Because I gave it to customers 100. Okay? I give to customer 100 units now. So that's why my inventory decreased 100 units. But since I give it to customers 100 units, how much money you will ask customer pay now? Of course, 100. That's why accounts receivable, I ask customer pay me money back 100% because you give them inventory 100. So you ask for 100. Okay, any questions? So that's what happened now. So inventory decrease 100, accounts receivable increase 100. This happened now because there's an actual situation, right? Any questions? So first thing I know, true sale 25%. And I give to customers 100%. So what's the difference? The difference is we expect maybe something will happen in the future. So something will happen in the future. What's that? Maybe we expect the inventory will back to you. Okay? If in the future inventory return from customers, so what did you get? Inventory, right? If customer return 25% product to you in the future, so in the future you will get inventory. So actually, estimated inventory returns is our inventory, but it's for future. If in the future customer return inventory back to you, so our inventory will be increased. So it's inventory for future. Something happened. Customer return something inventory back to you. So this account means your inventory in the future will be increased in the future. Okay? When customer return the product back to you, 25%. So that 25% talk about the future event when something happened. What's that? Customer return inventory back to you. Okay? Any questions? So when customer, if they return 25% to you, you got the inventory in the future. If that happened, could you ask customer pay you 100%? No, you cannot, right? Because if customer return 25% inventory back to you, could you ask customer paid 100%, 100 unit money back to you? You cannot, right? So that's why we will have maybe a return liability. So what's that? If customer return the inventory back to you, then we have to return some money back to them, right? For the right. So that's why we have the return liability incurred. So what's a return liability incurred? It means when customer return inventory back to you, you have to accept the returned inventory. So you have the obligation to do that. Why? Because you promised them at the beginning. Okay? Any questions? So you made the promise now. So you have the obligation. What kind of obligation? Accept the products in the future. Okay? Any questions? No problem. So what happened? You sold the product 100 units to customers. So you will ask for the money accounts receivable 100%. But at the same time, you made the promise, right? So what the promise you made? The promise you made is if customer return the product back in the future, you have to accept that. So return liability talk about the obligation, the promise you made now. So you have the obligation to accept the 25% return inventory if they happen in the future. Okay? Any questions? Based on this, that's a journal entry we use for this case. Okay? No problem? Okay. So let's look at today, the first day. What happened? You sold 5,000 inventory to customers. Also, you expect 400 is going to return in the future, right? So based on this, don't forget, this case, you could use only net methods. So that's right, we have to consider net amount. So what's the net amount? The fixed amount, consider variable consideration. So the fixed amount is the money or the selling price we have. So this is your fixed amount which sold to customers. But we have to think about what kind of event could happen in the future. So this is what could happen in the future. This is your variable consideration. 变动对价. So after that, we note the net amount, the true sales is only $4,600, right? So based on this, you have to recall the true sale. So the true sale $4,600 means what? The true sales means the true revenues we expect to receive in the future should be $4,600. But don't forget, we give it 100% inventory today. So I still will ask the money for 100%. But at the same time, on this same day, we promise we are going to accept the return, right? So we have the relative obligation is for that $400. Okay? So if we use the percentage, it's like we've mentioned, this is 75%. This is 100%. Also, your promise for that 25% is what? The return inventory. Okay? The question will use periodic. So that's why we don't talk about the second journal entry, because we use periodic. But don't forget, when we talk about perpetual, then you have second one. Okay, so did you find out? When we think net amount, true sales is $4,600. Accounts receivable is your right, your assets, right? Return liability is your liability, your obligation. So these two, when we want to get the net amount, did you find out? Still the same as what we think, the true value, the true sales, $4,600. So did you find out? Your assets minus liability is our net assets. So net assets, did you find out? This amount is your net assets. They emit what we think. What's that? Our true sales. Okay, any questions? If you don't have any questions, you can look at your note on page 15. Page 15. Just finish the first journal entry right here by yourself. So on January 4th, you sold inventory $5,000. At the same time, you expect 400 of inventory will be returned back to you. So for this, we use net methods. So how we record this situation? But here ask only periodic, so you don't need to record the second journal entry, cost of goods sold. You just record only about revenues. Okay? Using net methods, so what should we do? How we record the situation? Okay, finish here? Maybe if you finish, take a break. Okay, later when we come back, we double check the answers.